Hi everyone, welcome back to Be Rich. It's me Vinod here recording remotely from Bangalore. Happy Holi for those of you who celebrate this festival. Today the markets were closed thanks to the festival. It's a holiday in Maharashtra, North India, though it's not much of a holiday down south. So if you're wondering why the markets were closed today, that is the main reason why the markets were closed. So today I want to take this opportunity to talk about what has been happening in the market and who is carrying the brunt of the pain. A lot of you must be wondering, since the market has been correcting so much, who's carrying the majority of the load of this pain which is there in the market? Sadly to say, the majority of the pain is being felt by the retail investors. People like you and me are carrying the majority of the pain. So this video I'll walk through what is happening with the retail investors compared to FIIs and DIIs, what strategies you can do and use if you're a retail investor who's suffering, what you should do. Some of it is logical, some of it maybe you didn't think of. Maybe you can implement it going forward. So stick around to the end of the video. Hopefully you'll get some clarity on what to do when the markets open on Monday. The funny thing is, most of the stocks that's around 20% held by retail investors have fallen by 45% from their 52-week highs. That's quite a huge fall for any investor to see. By contrast, the domestic institutional investors, the DIIs, 20% of their holdings have only corrected by 34%, while the FIIs, their holdings of 20% have only corrected by 29%. So you can imagine, retail investors, the correction is 45%, while the DIIs have around 39% and the FIIs have 29%. So you can imagine by now wondering how come they are not suffering as much as the retail investors are suffering. That's going to be very clear as I get further down into this. The Sensex and the Nifty are both down 14.3% and 13.6% respectively, while most of the mid-cap and small-cap stocks have all come into almost bear territory. We're almost down by 20%. This is the market-wide decline which I've been talking about. So why is the retail investors hurting more than the FIIs and DIIs, meaning down 45% compared to their 39 and 29 respectively? The main reason is because retail investors are panicking and they're selling in panic. Majority of the sales which are happening by retail investors are panic selling, like I said, margin calls, and lack of institutional support. Institutional support means these are the stocks which the DIIs and FIIs tend to be buying during correction, which will cushion their losses. So that means the stocks the retail investors are investing in or have invested in are the kind of stocks DIIs and FIIs are not touching. So when they do correct, there is no one in there buying it and there's no cushioning for them when it's falling. The main reason for this, a lot of retail investors have been betting on small caps. And despite their losses, the retail investors are holding almost 10.3 trillion rupees of Q3 FY25, only second to promoters. That means the only person holding more small cap than the retail investors in their portfolio are the promoters of these small cap companies. That shows you the amount of pain which is being felt because the biggest corrections have been in the small cap, and that's where the FIIs and DIIs usually do not participate when markets start correcting. So if you look at in comparison how much retail investors' portfolios are weighted at small caps compared to DIIs and FIIs, retail investors have 26.56% in small caps compared to FIIs who have 21% and followed by the DIIs at 24%. So retail investors by and large are the biggest players in the small cap sector. The strange thing is the large cap, where the pain is not being so severe, is mainly being controlled by the DIIs and FIIs who control over 35% of the stocks in the large cap sector, while the retail investors have only been participating at 12.25%. And large cap stocks usually help protect the portfolio during high times of volatility, which the DIIs and FIIs have been enjoying, and the retail investors have not had a chance to participate in. So what should be your strategy, right? I've told you the retail investors have been heavily weighted in small caps. They've been not looking at these large caps, while FIIs and DIIs have been buying large caps in these corrections, cushioning themselves, and their losses are not so severe. Well, from going forward, if you're a retail investor and you've been suffering, first stop panic selling. Panic selling is no good. Have a clear-cut strategy on what to do with your stocks and your positions which you're in, even if they're in severely corrected states, meaning they're in severe losses. You have to do the following things to help yourself resolve this. First, look at the earnings of each of these companies. If the earnings in these companies remain strong, the recovery for these companies, individual companies, are going to be more likely. So keep an eye on the quarterly earnings for these stocks which you're holding and don't panic sell. Second, if you're looking at investing opportunities as a retail investor now, please look at quality stocks. Focus on quality stocks. Don't go chasing momentum. Chasing momentum means seeing a certain stock or a small cap suddenly correcting or severely correcting and not looking at the fundamentals and just running after the stock just because the market seems to be throwing it out. There could be a good reason sometimes the market does throw out. Yes, we do say the markets behave irrationally at times, but there are times when markets also behave very rationally, and if there's a reason to sell, they do sell. So do not go chasing momentum, focus on quality instead. And let's say you already hold on to stocks which are fundamentally strong but are down. What should you do? My advice would be, if you're holding on to fundamentally strong stocks, what I tend to do is I tend to hold them and I try to buy them more as prices correct. So I can look at something known as dollar cost averaging or rupee cost averaging, or what we famously say in our group, Tiffin cost investing. So if you have, let's say for example, the way I'm treating IndusInd Bank is this way. I have invested in IndusInd Bank and I continue investing in IndusInd Bank because I believe in the company, I believe in the promoters. So I feel the bank is fundamentally sound, every opportunity I get, instead of selling it, I try to hold on to it and add more as I can, bringing my average cost down. So what should you avoid? You should avoid companies with high debt and very poor management, and you should exit these companies if they're already in your portfolio. Learn to cut your losses and move forward, because these companies are the ones which will continue hurting even more as you go, and try to shift to your strategy, like I said, to better quality companies. And the trend, if you can see, what the FIIs have been doing is a clear line indicator on what is going to be happening to our markets going forward, at least for the short term. They've already dumped 1.4 trillion rupees worth of stocks have been sold by the foreign institutional investors, and that's one of the worst starts for a year we have had in a long time. However, other side of the coin is the domestic institutional investors have been buying 1.7 trillion rupees worth of stocks. That's what has been stabilizing our market somewhat. Remember what I said, the key thing is it's somewhat. These numbers, when I say 1.4 trillion sale by FIIs and 1.7 trillion DIIs are buying, it is broad market. We do not have information on specific stocks, what they're buying, specific stocks they're selling. So you have to be very careful in what you buy. And that's what I was talking about previously in the video. Focus on quality stocks with good management which have earnings potential going forward. Those are the ones which are going to recover. Avoid companies with poor management and avoid companies with a lot of debt. Those are going to continue to suffer even more as the market corrects. When will this pain end? When will we see a bounce back that nobody can predict? Even Mr. Trump and even Mr. Musk, if they reverse course in their decisions in the US, it's not going to tremendously overnight change and bring everything back to where it was 6 months ago. Markets take time, even when corrections calls have been made. That means even if the government enacts ways to correct and improve the market, it takes time for the market to move and react, because the market needs to start seeing it in corporate situations. That means businesses have to see better sales, earnings have to start improving. All this to happen takes time, quarter after quarter, and it builds up slowly in terms of momentum. So don't expect any fast recovery. If you are in a lot of pain and you can hold your positions, try and hold them if they're good stocks. If they're not good stocks and you have some terrible stocks, maybe it's time to cut your losses and move to better stock. And most importantly, these are situations where volatility is your friend as an investor. Find courage to stay invested if you can, and keep investing in small incremental amounts, and you will get there finally. This is what I wanted to share with you on this day. As the markets are closed today, I really don't have any market news. There's another follow-up video which I'll be putting out on Sunday, which is like a part 2 to this. Do catch it on Sunday, which we talk further about institutional investors and retail investors and what you should be doing and what they are doing. Thanks for watching Be Rich today. I hope you had a wonderful holiday. Those of you who are celebrating it. Otherwise, nothing else more to say. Good night and see you tomorrow with another video. Bye.